We are live and we're now up 296% year to date, turning every $10,000 into $39,600. Quick look at Portfolio Builder's track record. Our safer strategy had a really nice return yesterday with what we predicted would be a face melting melt up, predicting that McConnell is a traitor and would throw the Democrats a bone. Exactly what happened. Safe growth is up 2.15% in December or 31% year to date. We had some volatility in crypto assets last Friday, which was really bullish. We'll talk about that. Buy the dip, buy the dip, buy the dip. High risk growth portfolio has recovered half of its drawdown in December, down 4%, up 296% year to date. Who cares? The Bitcoin blowout Friday was a manipulated move that was designed to steal crypto from retail and load it up into the whales accounts. I'm expecting Bitcoin to go parabolic into the summer. So buy that dip. The new variant is bullish. This could potentially delay the Fed tightening. That's our biggest threat, is the central bank tightening monetary policy. That will absolutely collapse just about everything. Crypto, emerging markets would be the first to get whacked in the head. We had a pathetic 200,000 job gain. Last Friday was the news. We'll get the CPI on Friday. Again, this is bullish. This means the Fed needs to slow down its roll on quantitative tightening. Biggest driver for the next 6 to 12 months will be corporate stock buybacks to the tune of trillions, more stock buybacks than we've ever seen in history. Biden's getting ready to push $2 trillion in social spending, highly inflationary, and that looks very likely to pass between now and probably early January. China's officially lowering interest rates and dumping money into the market. They have grown their balance sheet by about 3 trillion less than Europe and the US. And that's what these banks like to do, take turns printing money. China is going to step up to the bat while the US and Europe slow down. The Turkish lira continues to make the dollar go up. It continues to devalue, but likely China, which wants to consolidate the entire Asia, is likely to buy up Turkey in one big deal, and that will be very bullish for our portfolio. So that's what's been actually impressive. Inflationary bets against the dollar doing so well as DXY keeps coming up higher and higher. So yeah, we could either have IMF or China bail out Turkey. And I believe we're going to get a dovish or a money printing surprise December 15th from the Fed FOMC minutes, which could be the rally ripper we're looking for, accompanied by big stimulus. Now, again, the labor recovery is going slow, and the new variant that's freaking out everybody, all hype, but we are starting to see some lockdowns throughout Europe. We're a few weeks behind Europe, keeping a close eye on it. I do think we're going to have a huge wave hit the US. And it'll be enough for Powell to get up on his little podium and say, you know what, we've got too much uncertainty to get too aggressive right now. So what are we looking at? There's nowhere else to invest your money. Cash is trash. The trade deficit did pull back a little bit. We'll take a look at that. But we're running massive twin deficits. So the US government's borrowing money at record pace, and our economy is simply importing all its goods and services. So this is a great way to weaken your currency over time. So bonds are garbage. They're way below inflation. Okay, who wants to get paid less than 2% a year when the inflation rate is in the 6 to 12% range? It's absolutely asinine. So central banks globally are stuck. If they let interest rates rise, everything collapses. If they don't, the inflation keeps roaring higher. So investors really have no other logical option other than to invest in the exact assets we're recommending. So if you're new, this is a red alert, buy, trade alert. We're long stocks, crypto, commodities, and we think it's going to melt up all the way till around June. That's when the fiscal cliff and all sorts of problems could begin to develop. And really, the only thing that would catch us off guard would be if Biden's Build Back Better plan is blocked. I believe that at most could create a 1 to 2 month crash before they would get their act together and push this budget through. Biden's polling and Kamala Harris's polling are at record lows. I believe it's now in the 26% approval range. So they know this is their last desperate hope to pass spending. And I do think they will pull it off, which is how we're positioned. This was the news that we predicted that McConnell would allow the Democrats to have more time to get their bills passed. He said he would not do it again after he did in September, and he just did it again this week. So the market loved that, ripped higher, and now we can see if they get this new bill passed. Now, a failure to close the deal would absolutely cause problems. We need to realize the US government's the largest corporation in the world. It's the main source of inflation or deflation in the global economy. If they were to dramatically slow down deficits, it would be extremely deflationary to the global economy. And that would create a stock market crash, a commodity crash, a crypto crash. We're hedging against that risk with UVXY, which is a leverage bet on the VIX, which is really just a out of the money put option on the S&P 500. Now, last time we got a big tank was in March of last year. We did predict that one, and it went up 1,100%. I think the next crash could be far larger. We're looking for potentially a 2,000% gain on the UVXY position. I think it's unlikely you're going to get rich on this play this Christmas, unless the Fed makes this massive policy mistake and starts telling everybody on the December meeting that they're going to double the pace of tapering and do a bunch of rate hikes early. So we will have a good position, not a huge position leading into Christmas. But again, I think it's going to be highly unlikely. I believe this is all a big bluff of governments and central banks globally to try to slow down the inflation a little bit while they get these budgets passed into winter. But the market could fall 40% and still be at the February 2020 level. And get this, we had 5 million more Americans working in February, where the S&P 500 was 40% lower than it is today. Okay, so let that sink in. The only reason the market's gone up so much is we ran a $3 trillion deficit last year. So it's absolutely critical the US either recovers at least 4 million jobs, which is not going to happen anytime soon. Looks like most of the people who left the workforce have no intentions to return. They've made too much money in their stock account. They're just going to sell those stocks and live on that for now. But that's where we're at. The government must keep running massive deficits to keep this party going further. If they fail to do it, look for a massive, massive sell-off panic. And imagine getting a 20-to-1 return in a few short months with one position. So anyways, I don't think this is in the books until probably Q3 of next year. We're expecting a melt up, lots of spending, a reversal on this hawkish Federal Reserve in China going pedal to the metal with spending. So you want to get built out. We like to combine the safe growth with 70% of your capital, and then throw 30% behind our high risk growth strategy, and then sit back and let it melt up. Here's the big picture of what we're anticipating, and it's an inflationary cycle that will last approximately 5 years. The formula to create this inflation is to first crash your economy with a bubble of some sort, then to increase the rate of deficit spending at the government, and then the last touch is suppress interest rates on bonds. So if you go make the cash position really stupid, you make the bond position even worse off, you force investors into everything else. And so let's just look at history of the dot-com bubble. We busted in 2000. They reduced the deficit 2001. What do you know? Lo and behold, you get a 2-year stock crash. And by 2002, they switched gears. We're going to run a $250 billion average deficit from 2002 to 2008, and you're going to suppress interest rates. And what do you get? You get the energy value sector going parabolic, a 300% return. So every $1,000 jumps to 4,000, and it took about 5 years to crash the economy when oil went too high. That's when you get the housing bubble. Okay, so what do we do this time? Obama comes in and rewards the fraudsters who created that bubble, bails them all out, and we're going to now jump to a $1 trillion annual deficit. We're going to do massive quantitative easing, suppressing interest rates, and this time you got an even longer energy value cycle. Lasted all the way up until Mr. Trump came into office. And that's when central banks suddenly thought we should do the opposite policies, which was to tighten monetary policy. So as you can see, tightening monetary policy made the cost of oil crash all the way until the big sell-off when we did global lockdowns. So what's the new plan? Well, we go lock down the globe, print trillions of dollars, do the fastest level of quantitative easing in history, and now we're running at a 3 trillion per year deficit clip last year. It's not going to be as high this coming year, but they know they need to spend as much as possible, otherwise this all comes unraveling apart. So I'm anticipating another good 4-year run up in value, outperforming growth. And likely that's going to really kick off once we get through this new wave of the variant, which I think will be dying down by February. So look for the fireworks to really spark in March, which is exactly when it took off last year. So we'll take a look at that in a minute. Now, when stimulus passes, it's very bullish for everybody else except the United States. That's because we import most of our goods and services. So look for EDC and EFO to outperform UPRO if you're following our safe growth strategy. Last December, Trump pushed $1 trillion through and Biden $2 trillion in December and late January. You can see emerging markets jumped higher, outperforming the US by 50%. Now, last year was funky. China's been doing all sorts of interesting things. This trend reversed itself, but I believe it's about to repeat and last for several years, potentially for 5 to 10 years of outperformance in Europe and Asia relative to US. So the other big thing to watch out for in your portfolio is for interest rates to rise. Tech stocks hate this. They hate it, and it forces money to rotate into banks and energy companies. And I think that trend is going to really stand out aggressively by March. And it's going to be fueled by passing these budgets. And here you go. So here we have the yellow line representing interest rates going up. We've got green representing the energy value sector, and then we've got the growth sector, tech. And you can see when we first passed the budget, rates were going up, energy was going up, and tech was going up. You were getting to have all your assets go up together. But then the bond market went into a free fall. You can see that yellow line went parabolic up. What happened to the tech stocks? They dumped, and energy went flying higher. So when you combine growth and value, you can really get a nice smooth return over time. Now, again, we did note that this reversed course, and there's a whole lot of reasons why it did so. But I believe the big picture, our interest rates are going to rise until we create an economic crisis, and that this is going to take several years to play out. Now, the other big thing that will help drive this exact narrative will be jobs coming back online. I'm not anticipating a whole lot of jobs coming back online until around March, because there's a very strong correlation to the scare tactics of the media relative to the sickness. We get censored on YouTube, so hopefully you can decipher what medicine means and what sickness means. But we're going to anticipate weak labor until about February, March. And at that point, I think we're going to start seeing a lot of jobs come back online, and that will drive those rates higher and continue this growth to value rotation. So we're not saying sell your tech stocks yet. In fact, we just had a huge melt up yesterday in that group and have been telling you to hold those positions. We'll look at some indicators to predict when rates will go up in the rest of this presentation. Now we have a trade alert coming out very soon, and if you're not a paid member, you're going to miss out. Call Dean right now to upgrade at 505-322-7515. All right, so let's look at our report cards, our track records. This is the safe growth strategy. Did really good in 2019, 25% return. 2020, I got caught off guard. I was too defensive. Just about every famous hedge fund manager, from Ray Dalio to Warren Buffett, was a little more precautious in 2020. It's really your silly retail go all in gamblers did really well in 2020. Just about everybody who wanted to sit back and be a little more careful underperformed the market. So I'm not upset that I underperformed in 2020. Had things gone wrong, we were looking at a Great Depression scenario, and we still may have some pretty big problems coming down the pipeline if Biden can't replace these 5 million jobs that have suddenly disappeared, and suddenly Congress is unable to keep running these $2 to $3 trillion deficits. So we're not quite out of the problematic time zone yet. The money printing just simply delayed the inevitable. Now, 2021, we've done great, and closing out December very, very nicely so far with a 2% return. The high risk strategy has been betting big on crypto since December when we launched this portfolio, had a 4% return December 2020. We nailed it, predicting that this was going to go big time. Had a huge gain in January, 127%. We've had some other big months. April was a 28% gain. August was 22. October 33. Some of the lower month prints, March we were down 10. May we were down 19. And we've had a few relatively flat months. So that's the way this high risk portfolio goes. You put your money into the strategy, sit back. We're going to hedge you against all these critical risks. And then with a little patience, you can see this does grow your wealth rapidly. Now, again, my favorite combo is to do 70% in the SAFE strategy, which is a global equity strategy, and then 30% in the high risk formula. And if you've done that, you're up 115% year to date with a very safe, extremely diversified strategy. You own every major company in the world. Let that sink in, how safe that is. Now, what's really neat is when you do upgrade your free trial, you're going to gain access to our membership area where we have the formulas in a software algorithm. So you can just type in how much money you want to invest. And it's going to print out exactly what to buy. And more importantly, let's say you want to pull some profits off. Let's say you've made a bunch of money and you need to pull off $5,000. Well, just punch in $5,000, hit calculate, and it'll tell you how many shares to sell so that you remain balanced at all times. Now, a bonus that does occur when you upgrade is access to our private equity fund. If you want to replace the high risk strategy with an even higher risk strategy that I do all the work for you and pay out a 1 to 2% monthly dividend, consider our Rebel Dividends private equity offering. The cost per share is now at $1.18. We have just over 1 million shares outstanding and just under a $1.2 million value in the assets held. Now, what I'm doing is investing in a much more aggressive group of cryptocurrencies, and I'm providing liquidity to create income in decentralized exchanges. Now, again, legally, this is only available to paid portfolio builder members. Thanks to Obama, he created something called the Jobs Act, which allows us to have up to 35 non-accredited investors take part in this private equity offering. Normally, this type of opportunity is only available to accredited investors. Those spots are getting filled quickly. So after there's 35, we legally cannot take any more. So don't delay if you want to get in on that. We're currently onboarding about $600,000 worth of new shares, and it's just taking a little bit of time to get the money through the banking system into the crypto. The banks do not like this at all. Neither do the brokerage houses. They're seeing money get out of their system and into the new world system. So if you want to get some money off grid and get some consistent income and get it out of the overreach of the government, that's what Rebel Dividends is all about. Here's a look at what we're currently holding outside of some cash positions. I just did a big Bitcoin purchase and have been making some more optimizations. So we did finally clear out my schedule. I'm no longer taking these calls. You have to talk to Dean if you want to get in, which is important because I have a lot of work to do as we're planning to exit GBTC, ETHE, NRGU and become a full-blown market maker at 8 different decentralized exchanges. After beta testing this for a few months, we're having amazing results. And here's what the new asset allocation will look like. We'll be having some put options and maybe even some call options in certain products over at Interactive Brokers, which will represent around 5% of our capital. So out of the money puts on companies like Marathon Technologies and potentially out of the money call options as well. We're going to be providing liquidity to QuickSwap, where there's massive yields to be earned, getting people in and out of the coin Polygon. The biggest decentralized exchange in the world by far is Uniswap. Their market cap rank is around 12 out of thousands. This is the single most successful software application on the Ethereum blockchain to date. So that's our largest position there. A smaller place is Sushi Swap, which will have 5%. And then we're looking at all of the competitors to Ethereum. So for Cardano, Sunday Swap, they're in beta. They're going live January, February. We'll be amongst the first to get in on that. Solana has a live decentralized exchange. Radium, Polkadot has Polkadex.trade. The Binance Smart Chain is already active with PancakeSwap. That's where we've been testing this model out. And then Trader Joe XYZ for Avalanche. So think of this as the operating systems of blockchain. And we're going to be trading the pairs against all these hot new software applications coming out. So very, very exciting. And I do believe we'll be able to deliver a 1 to 2% dividend easily to our shareholders, maybe as high as 3. So very, very exciting. The dividends are generated from trading profits. So as people want to flip in and out of these currency pairs, we get to collect the transaction fee. That's what we're going to dish out for your dividend. For the growth, we're just going to hold these extremely valuable cryptocurrencies that are the operating systems and hold those as they grow in value. Now, if you want to invest and you're a paid member, call Victor now to schedule a consultation. It'll be with Dean, not me. I have to focus on getting all this work done. So call Victor now at 505-203-0396. Remember, we can only have 35 non-accredited investors. Those are filling up fast. So definitely do not wait to take advantage of that. Okay, great. I'm going to now hop into the meat and potatoes of my presentation. Okay, the biggest problem for the way we're positioned is that the inflation is out of control, and there's a risk that central banks are going to raise interest rates and that governments will slow down spending to fight off inflation. Now, that's what the Fed has been signaling through its various media outlets, is that they will double the pace of tapering in January and begin hiking interest rates as soon as March. Markets currently pricing it in almost as a certainty by June or July. This is not going to play out well, not unless they can get massive amounts of jobs online. So I think it's a bluff. At this point, I believe we're going to get a dovish surprise come mid-December. Jeffrey Gundlach had his total returns update last night, is predicting 4 rate hikes would collapse the economy. So again, we're nowhere near 4 rate hikes, but again, the market's going to look into the future and react to what they think is going to occur. So this is a massive problem, and the best way to benefit from a policy mistake would be to own a big fat chunk of UVXY. Right now we have an okay position, but not nearly enough to protect us. So are they going to fight inflation and crash the economy and labor markets? Or are they going to do these bluffs against inflation and continue to recover the labor markets? At this point, I believe it's a bluff, and they're going to focus on the labor recovery. The last print was really, really weak at 200,000 jobs. And so we'll see how this plays out. Likely, I will play it safe ahead of those FOMC minutes mid-December. And I'm watching the new variant. I'm watching Europe for lockdowns. All this type of talk is very bullish for how we're positioned, because it means it's going to delay the Fed from tightening. And then meanwhile, we got China pumping up the money printing as we speak. Let's look at the yield curve. So on the x-axis, or left to right, we have how long you're going to loan the government money. On the y-axis, we have what interest rate you're going to get. So the inflation is, on the core CPI is at 4.6. So why in the hell would you want to get paid 2%? You wouldn't. So the only people buying up these debt products either think that the stock market's going to crash and force people into treasuries, or it's mainly just big banks who are desperate to find yield so they can pay deposits. And so that's really what we're seeing, is because governments globally printed so much money and everyone has just parked it in a bank account, now the banks are forced to pay interest on these deposits. So they are fighting tooth and nail to buy up these debt instruments to pay interest on the deposits. So what's going to happen is the governments start to slow down the free money and people have to start to dip into their savings. Well, there's going to be less demand for these treasuries and interest rates are going to go up. That's primarily what I'm expecting to happen. Now, the other side of the equation is when we start to issue a lot of debt. Will there be the demand for it if it comes in all of a sudden? So in the black line, we can see what the yield curve looked like in October before Trump and Biden came in with $3 trillion of stimulus. All the rates were low. There was high demand for all debt instruments. And then all of a sudden we go past $3 trillion and look at the green line. The interest rates rose rapidly. And that's when you got that crash in Bitcoin and tech stocks in March. Then what happened? We failed to spend money all year. We failed to bring jobs back online. We had lockdowns through Asia, and all those interest rates came right back down. And we're actually inverted now on the 20 and 30 year. The big thing to note, though, between last year and this year is that the 2-year has gone up parabolically, up several hundreds of percentage points, while the long end has come back down. This is telling us that the bond market thinks the Fed needs to hike rates to fight inflation. That's what we're seeing on that short end. But if they do it, it's going to crash the economy. And that's what we're seeing on that long end. So damned if you do, damned if you don't. Here's the VIX futures term structure. We're most interested in where the dots jump the most, still jumping the most between now and January. And it's because we have that critical FOMC minutes, December 13th through 15th. If they signal they're going to double the pace of tapering and start hiking interest rates in March, April, or May, I do not think the markets are going to like that one bit at all. So if we think about this as a game theory and you're the Democrats, would you want to crash the economy early so you can go into a new QE cycle leading into midterms next year? So I think they're either going to crash this very soon and get into accommodative policy early on this year, or wait until after the midterms occur next year. So we're either looking at potentially a Fed policy mistake in early 2022 or early 2023. I don't think they're going to do it too close to midterms. So all eyes on the Fed, some very critical decisions being made in the next few weeks. Don't freak out if you're a portfolio builder member. I'm going to hedge you up nice and safe so you don't have to worry about it while you're enjoying time with your family leading into Christmas. My bet is they don't want to ruin their polling even more than it is right now, and that we're going to delay the rate hikes. Okay, a good way to predict if interest rates are about to rise is look at reverse repo. The bigger the number, the more bullish for growth and the less bullish for value. So this is still running at $1.48 trillion. Very bullish for growth, which I would basket Bitcoin and tech stocks into. All right, here's the global macro in one chart. Again, we have interest rates in gray. I guess I should switch that to yellow to be consistent with the other page. In green, we have value or energy, and in the black, we have growth. So that's the tech stocks, and that would also be most likely Bitcoin. So just fantastic to see how close those interest rates are correlated to the value, and why we can see the growth does the opposite of the rates. So as you can see, in general this year, we started off with rates jumping and energy went parabolic. We had rates fall back down, pulling energy back down with it. What comes next? Are rates going to zero? Everybody gets free money indefinitely? Or are we headed towards a cycle of rates rising? I believe we are headed towards a cycle of rates rising. So that NRGU position is so important to your portfolio right now. Here we're looking at the Russell 2000 relative to the S&P 500. This is Stanley Druckenmiller's favorite leading indicator for stocks. It did jump early in the year. It's traded flat. We got a breakout for a little bit, pulled back. I believe the catalyst that'll make or break the Russell 2000 is the Build Back Better spending bill. So right now it's showing a more of a bearish slant. And so we're going to keep a close eye on that. Okay, emerging markets been a dud this year, but will it continue? I believe this will be your best performing index for the next decade. And as you know, we have adopted our strategy, so we have no choice but to get that position into play. If we're going to crash, there's probably a lot less downside risk in emerging markets relative to the S&P 500. If we're going to rally, there's likely a lot more upside on emerging markets. So that's the main thought process. Now, also emerging markets has been good at predicting crashes before they occur in the US. There's a lot of good examples of that throughout history. Here's a look at EFO. This is our European index. This one does really well if rates rise. It's been doing very well all year, and I believe it will continue to do so. It's trading at far lower valuations than US stocks as well. So more bang for your buck. Okay, in this chart, we're comparing Bitcoin to Ethereum, and very interesting. We're now seeing less downside risk on Ethereum and more upside value or returns on Ethereum. So I do think it's important to have Ethereum in your bucket of assets. Gold and silver just been really boring. Jeffrey Gunlack says he thinks the dollar needs to fall for this to occur. I really think we need to see whether or not the labor is going to recover before this one gets exciting, and for rates to likely top out. So we don't have a lot of exposure to either of these. We got a teeny tiny silver position right now. I like silver over gold, and I like the leveraged silver play with AGQ. So it allows us to have less money, and if we get a short squeeze in the silver markets like we've had in several periods of time, well, we're going to have that exposure with AGQ. Okay, our deflationary assets we like are the dollar, EUO against the euro, treasuries, TMF, and then UVXY, the VIX or SPY puts. The dollar's overvalued, in my opinion, currently. The treasury market's probably the most overvalued asset in the entire history of the US currently. I'm not a big fan of that at this price. So the VIX. So UVXY is going to be our play for a crash for the foreseeable future. Nothing else makes a whole lot of sense. Some other plays we're keeping an eye on are rare earth metals in green, uranium in purple, and oil in pink that are not already charts we've looked at. So oil's been crashing, but getting a little bounce. I've been telling you I'm getting ready to increase that position for high risk. We've got uranium trading flat and RMX trading flat. If I zoom out a little bit, you can see RMX has been one of our favorite plays since June of last year, up 259%, uranium up 138. Oil had this parabolic move, crashed. I think it's getting ready for a new leg higher. We'll probably play this through February and then hop into betting that food inflation is going to hit global economies next. So I like to be long the price of wheat, soy, and probably a ticker named cow. You can imagine what that plays. So very good. That's lithium is the main play for RMX. We're going to need 20 times as much lithium. To get the lithium, we're going to need a lot of oil. So how funny is that? We can go build a bunch of electric vehicles, but who cares if you're going to power them with coal plants? You got to replace the coal plants with nuclear power. So those are both beautiful long-term plays that we will be bullish on as long as central banks aren't doing quantitative tightening to kill inflation. That's our main threat for just about every asset we're long currently. Why is the dollar going up? Is there any other currencies falling off a cliff? No, it's just the Turkish lira and the South Korean won, but it's mainly Turkish lira. So that's where all the pain has been and making the dollar go up primarily. I believe Turkey will have to be bailed out soon, and that will weaken the dollar and make all of our positions go up dramatically. China's currency is strong. We've got new import exports, new record highs for China. Been telling you China's kicking our ass and taking names. So we want to bet big on emerging markets. Here's NRGU. I think this is going to go towards 600 before we're really freaking out. We'll take a look at what it really trades, which are the top 10 US oil and gas companies that now have monopolies for producing oil in the US. This government's administration is basically giving them free rein to make more money than they've ever made in history, cutting out competition, driving the price of oil up, and then a general climate change agenda. So super bullish on NRGU. Hold on to your horses. This puppy is volatile. It's 3 times leveraged. Our signal to get out will be DXY falling towards 90. So let me pull off. Let's go ahead and hide these and look at DXY one more time. So this is the level we're going to probably take a lot of profits on, a whole lot of our assets. So the gains we've had with the dollar going up are phenomenal. Wait till this falls back down. The returns could be ludicrous. And at least we know when to sell when this gets towards 90. Okay, in the crypto world, we'll look at some other charts, but again, we had that volatility. Bitcoin hit 42,000, 440,000 accounts were liquidated to zero. You don't want to stop loss in crypto, and you don't want to use margin. And you also don't want to go lend your Bitcoin to BlockFi or Celsius. Those are 3 ways to lose all of your money. Don't do it. We're not doing that at Rebel, and we won't do that in any of our portfolio builder strategies. Okay, so I'm not going to spend a ton of time on all the cryptos today. Now that I'm not doing all these calls, I'll have a much more built out presentation for you every Monday, Wednesday, Friday, telling you everything you want to know about crypto. Let's focus on macro today. We're going to anticipate that we're going to have a lot of cases ramping up through February. And so far it's starting to pick up. I believe this is going to go much, much higher. Slow labor recovery and slow down the Fed. So we'll see how that plays out. Here is Germany, highly medicined, lots of rules, lots of masks, and it's not working. And what's happening there tends to happen here, delayed. So keeping a close eye on it. This will be very bullish for markets because it's not creating hospitalizations, it's just creating cases and some restrictions on movement. Here's that rate of change. It's picking up a little slower than I would have expected, being the first week of December, but it's really mid to late December where this likely will go parabolic. It gets cold, everybody goes into small confinement, and sickness is spread, and it happens every year. So I do think that will be bullish for the way we're positioned. Now, the good news is this one's not creating a lot of hospitalizations, keeping a close eye on that. This one's only tracking the particular sickness, but I think we need to look at overall hospitalization levels and see if hospitals are getting overwhelmed. Because if there's a lockdown, that's different than just cases. And we would have to probably sell our oil play temporarily. Now, this is the way to figure out, another way to figure out when to sell NRGU. When ExxonMobil hits a new high, okay, so I do think it'll break into new highs this cycle. It's at 62. Its recent high was around 100 in 2014. And so again, that's exactly where I think it's going to break through and be a good signal to take profits for NRGU. Just another chart looking at interest rates and oil and how correlated they are. So what do we think is going to happen? Oil going to crash, rates going to zero, or the opposite? As you know, I believe the opposite's going to roll out here. Are we seeing weakness in copper futures? No, no weakness there. Tends to trade flat, then leap higher. So that's bullish for how we're positioned. Now look at this relative to our gas play. So the lumber sector went just nuts. Went to 1800 after decades of trading below 400. So just absolutely insanity. Then it had a parabolic crash to 400, and now it's back to 900. What are we now seeing in natural gas? Okay, we had to go parabolic, crashed. Has it bottomed out and getting ready to ramp back up as we go into the colder season? That's what I think we're on the verge of, and getting ready to double our boil position. Haven't done it yet. I've been patient. Baltic Dry Index. This is measuring the cost to ship commodities to various continents. Same thing. It's gone parabolic, it's crashed, and now it's rebounding. So we're really seeing the same pattern. The governments are doing what they can to slow down inflation, but it's not working. All right, here's the bond market. Same thing as the yield curve, just in a different format. 2 years going up, long end going down. It says we're going to have to hike rates to fight inflation, but it's going to crash the economy. So not a good situation for central banks. Gold copper ratio, just a good example from 2002 to 2006, which is what I believe we're on the verge of repeating. Be careful about betting big on gold and silver. You're probably gonna make more money on oil and copper and lithium, unless we just have a complete, utter disaster with the economy, which I'm not saying is impossible. I just think it's too early to tell right now. Okay, these are the three critical bond markets we track: TLT, JNK, LQD. If any one of these three is going down rapidly, that means a crash in stocks is likely to occur soon, because that means either the government or corporations can't borrow money. And don't be fooled. They both need to borrow money to keep this party rolling along. No crash in sight. Everybody's got access to money to keep the party going. Here's where we would be watching Janet Yellen issue debt. If reverse repo is above $1 trillion, go for it, Janet. Borrow as much as you like. She probably wants to get it back towards 800 billion, and I think it's running on fumes right now. Although McConnell just passed or just agreed to a deal to let her borrow some more money to keep the government rolling through winter. Okay, the non-farm payroll came low. Now, we need to realize they did mark up the summer months way higher than they were. Why would they underreport labor? Because they don't want interest rates to rise. So this could be a low ball number to help keep rates lower for tech companies. So we'll see how these play out. I don't think you're going to get a very good print until March. And I also don't think the Fed should hike rates unless they can push 700,000 jobs through for the next 6 months on average per month. So are they really going to double the pace of tapering and start hiking rates without the labor recovery? And if so, would that be a disaster? So that's the big question, the primary risk to markets moving forward. Friday, we'll get a new CPI. Jeffrey Gundlach's predicting this could go really high in the next 6 months and that it won't go below 4 for most of next year. We will see. The main things pushing it up now are rent, wages, and energy costs. So we'll see how that plays out on Friday. I don't have a strong opinion. I think it'll be above 4. The Fed should have been, if they were really worried about price stability, hiking rates 6 months ago. So are they going to keep the stock market alive and jobs alive, or are they going to fight inflation? Doesn't look like they could pull off both right now. Bank credit's growing. That's good. That's how we're positioned. Consumer credit's growing. That's how we're positioned. Interesting jump to 11 million jobs opened, signaling that they're having a hard time finding labor. Tight job market. Jobless claims coming in low, so more signals of a tight labor market that would make the Fed want to hike. Now, here's the big picture. And this is what's really driving the whole economy is the US has been hollowed out since the 90s because global corporations sent all the jobs offshore to dirt cheap labor. We had labor go up from 2016 to 2020, and corporations did not like that one bit. Just watch the media clips from 2016 to 2020. The only time we had a improving internal US economy in several decades, and the guy was made out to be the next Hitler. And what did they do? They hiked interest rates, quantitative tightening, totally made this guy look like the worst person on the planet for 4 years. And then I'm going to say it, likely did a planned global lockdown. So where are we at now with labor? We're 5 million jobs have disappeared. We got a little bit of a jump on the labor force here. This needs to go back up. We were on track to not only have these 5 million jobs, but another million or two. So either the government's got to keep the spending at pace of last year, which was 3 trillion in deficit, or we got to get a ton of jobs online. Otherwise, the spending's going to slow down and the earnings per share of corporations is going to crash. And this is likely going to occur by Q3 of next year. So all eyes on labor. That's probably the single most important data print for the next 12 months are the labor prints. Trade balance did crash in a positive way in the US. So that's a surprise there and does kind of match up to that dollar rising during this period. Apple at a new high. We're looking at individual stocks that could be problematic. Tesla still above 1,000. If it goes below 800, we're going to get concerned. ARK funds hanging in there. This one I think is going to go back to this 30 to 50 range. And we'll see if that creates systemic risk. China's Tencent, software giant, hanging in there. Important company. If Facebook doesn't own it, Tencent owns it. If it's an app, we have huge exposure to this with EDC. Alibaba, been getting hammered. And again, very important company in the global economy, watching for it to get a bid. This is probably the most bearish chart and probably a heck of a buy now that we see China starting to print money again. Samsung, was crashing but rebounding back, Toyota remaining strong. So we're not seeing a whole lot of warning signs. Here's a very bullish print. New record high for Chinese imports and a new record high for Chinese exports. So you wonder why I'm so bullish in emerging markets, even though the chart hasn't looked great. There you go, right there. US just hit, let's see, we had a little pullback. We'll get this updated tomorrow. My bet is it goes higher. And what do we get with the stock market? A big rally. So I bet you this prints higher tomorrow. This is going to probably top out above 9 trillion and will probably be where we hit a short-term peak in stocks potentially. We'll have to see what the Fed's really going to do here. Europe continues to grow their balance sheet, and Japan did a pretty good print too. All right, let's check out the news, and I'll see all the chat boxes popping in. JP Morgan's predicting $90 oil and S&P 500 at 505. Let's go. Currently at 468. And then we're going to get a rate hike and in QE. Now, Goldman Sachs thinks they're going to in QE do 3 rate hikes and hit 5,100. Highly unlikely we're going to have a very bullish stock market if they start tightening monetary policy. Here's a look at the Chinese credit relative to the others. So you can see the other central banks, the Fed and the ECB, have printed way more money than China, but these guys tend to take turns. So expect China to really ramp up spending while the US slows down. Okay, so we pushed a new bill through thanks to McConnell to raise the debt ceiling. He just said he wouldn't do it again in September, just came out and did it again. We predicted that. Gunlack had a webinar yesterday. As few as 4 rate hikes could break the economy. And again, it's rate hikes without labor. So if we get the labor, then people have income and the earnings stay strong for corporations. But if you don't get the labor, you tighten monetary policy and then slow down government spending, you're going to have a big problem. Gunlack says CPI could hit 7% or higher in the next few months. That would be wild. Now, normally the Fed would hike rates above the inflation level to kill it. But we've got it at 0 and we're running, on the CPI watch 4.6. So there's no way they're going to jump it to 4.6. Elon has been saying to scrap the Build Back Better plan. This administration does not like him for one reason or another. It says government's simply the biggest corporation with a monopoly on violence. Here's a look at the US debt, our revenue, and our deficit. So you can see this becoming problematic here. Likely unsustainable. We're going to have to reduce the debt or grow the revenue. Because if you keep the deficit running, it weakens your currency. And that's how we're positioned. Goldman Sachs says China has confirmed they're going to lower rates. Watch for China's credit impulse to explode higher. That's bullish for how we're positioned. And again, we're seeing in those exports, imports this print. Ammonia goes vertical. I think it's up like 10 times. It's 80% used as a fertilizer. So this means food's going to go up next year. So after we play boil, look for some agriculture plays in the high risk strategy. New York just launched some of the most aggressive rules around the medicine, similar to that of some of the European places. So yeah, that's interesting to see New York implement these different mandates. We'll see how that plays out. Probably not well. Here's Goldman Sachs predicting a 5,100 SPY, a little bit higher than JP Morgan. Of course, these guys are always bullish. Okay, very good. So that gets us through the top news. So I'm gonna do some Q&A. And then we will hop into asset allocation. Okay, so let's see what we got in the Q&A box. Jeff says the medicine's going to cause a mass die-off. I don't know. We'll see about that. Probably not. I think it's just used to control people. Mike says, can you tell us about the shark that got the minnows to cause? Yeah, so real easy. They saw about 440,000 accounts either using a stop loss or margin. And they were able to calculate how far the price had to go to be auto liquidated by the exchanges. And then they started dumping Bitcoin on a Friday afternoon while you're out having dinner. These guys were dumping Bitcoin, and it caused a cascading effect. So these guys weren't selling their accounts, they went negative. So if Binance or Kraken or Coinbase sees you're borrowing to buy Bitcoin, let's say you use 10-to-1 leverage, because you're a crazy maniac. Well, if it goes down 10%, you're now at zero. They're going to close you out before you get even close to that. So it caused the most leveraged people to sell first, the least leveraged people to sell. And the 20% move knocked out 440,000 accounts to zero. Once the carnage hit max pain, they bought the dip and brought us right back up to 50K. Okay, Stephen is getting invested with Rebel. Very good, Stephen. We'll keep a lookout for your money to post. Okay, let's see what other questions we have popping in. Okay, Jeff says, why are BlockFi and Celsius not safe? Yeah, so if you go lend your money into BlockFi for 6% a year, what are they doing? They're lending, so you're lending it to BlockFi. BlockFi is going to go lend it to Joe Schmo. Joe Schmo is going to go take your Bitcoin, put it into Coinbase, use leverage. Okay, and then here's where it all goes nasty. If the price of Bitcoin gaps lower faster than Coinbase can empty out this dumbass using leverage, he could end up losing more money than he has. So all of a sudden, the guy's lost more than he has because Coinbase couldn't exit him fast enough. So anyways, the bottom line is if you lend money to BlockFi or Celsius, you've lost custody of your funds. And that's where it is. It's when we get a big drop in price and it gaps lower that people could be losing all their money. So I absolutely would not do that. Let's see, Johan saying, can I fund Rebel with a company account? Absolutely, yeah, absolutely you can. I'll pull up Victor. So anybody, and again, we can only have 35 of these non-accredited investors, guys. So unless I set up a second corporation, which is a lot of work, I don't anticipate that happening. So if you do want to get, it's a 50K minimum, okay? Because we're only charging 2% a year. It's a lot of work I'm doing for you for 2% a year. So call Victor if you want to book that up at 505-203-0396. You'll be speaking to Dean as I am full blown getting the portfolios built. John says, how long can this bubble go on? It'll go on until the government stops its deficits or the central bank tightens monetary policy. In politics, midterms are next December. So if I look at, game theory, and I am a tech giant that controls the government, I've got the midterms and then I've got the next election. So when do I want to crash the economy to fight the inflation? Now or next January? So that's what I think are the most likely probabilities. I don't think they'd want to do it too close to midterms. But yeah, the inflation is driving the polling for Biden to record lows. So there's definitely thoughts in the government that they need to crush the inflation right now. But they haven't passed their bill yet. So great questions, guys. Okay, so I'm going to end the free version before we reveal the trade alerts. Okay, so now a lot of paid people see this screen and freak out. If you're paid or on an active trial, don't worry, your video is not going to end here. Just the folks who are not paid are not going to see the critical information that we're about to reveal. So if you're paid, you're set, and this video will continue. If you're not, you're going to get cut off. You're not going to get the trading formula to make money with a melt up into next summer. So very good. I'm going to go ahead and end the free one.